Market structures, depending on how freely firms can enter the market, we can sort of differentiate between them. Whether the firm is, or collection of firms are operating in perfect competition or an imperfect competition. Imperfect competition is anything not perfect competition. So it could be oligopoly, monopolistic competition, or monopoly, right? So whether there is a freedom of entry or not determines whether the firm operates in a perfect or not competition. But however, freedom of entry is not necessarily unique to perfect competition, because in monopolistic competition you have freedom of entry as well. In other words, it's easy to enter the market without difficulty, let's say, without barriers. Barriers could be in the financial form, a monetary form, let's say. You may have to pay fee, register your company, and things like this. Sometimes it's in the form of capital outlay as well. Some firms require a huge amount of investment, right? If you want to open a hotel, you need a big amount of money. Yeah, initial capital will be high. So that could be a restriction to your entry to the, let's say, market. But today you have Airbnb, so you can easily enter the hotel market as well, hospitality market, just renting out your own flat, right? So you are in the hospitality market with a freedom of entry here. Yeah? So we'll define and we'll give examples as we go. Nature of product as well determines what type of market structure you are operating in. For example, if you have undifferentiated products or almost identical products, then you are most likely operating in highly competitive market. If you have homogeneous product or similar product or identical product to others, then you are in a perfect competition. Or you can differentiate your products. In that case, you're operating in a less than perfect competition. Although it's a competitive market, it will probably be imperfect. There is some differentiation strategy you have. Advertising maybe, packaging maybe, the shape of the bottle your beverages, for example, have, so on and so forth. Yeah? Or degree of control over the prices. Also determine whether you are in perfect competition or elsewhere. Now, before we move on further, we need to distinguish between short run and long run. Number of firms won't change in the short run. To set up usually takes a long time, right? A firm. To start a firm, it may take a long time. So in the short run, it's a time within which number of firms are fixed. No entries, no new entries. But in the long run, we expect that the markets will be populated by more firms due to market conditions. It could be incentives to enter or incentives to leave the market, yeah? So in the long run, this is how the definition is now. In the long run, firms are able to enter and exit freely, or in the short run, number of firms is fixed. Now, in the short run, firms can make supernormal profits under perfect competition. But in the long run, firms cannot make supernormal profits. They make normal profits, but they still make profits. So we need to distinguish between the two cases here. Supernormal profit which is above average, and a normal profit, which is basically profit that every other firm makes from selling the identical product. Now, normal profits are usually positive accounting profits, but zero economic profits. And supernormal profits, usually above average profits, profits that cover accounting profits, and then there is excess of implicit costs as well. So we'll define this. I think you have this last week. I will briefly go over this concept, economic profit. And today in the problem sets, we will also have the exercise. Let's define what costs are first. So economists usually concerned with not only the out-of-pocket costs, but also opportunity costs. So we usually refer to economic costs as the combination of explicit costs, out-of-pocket costs, wages, rent, and material, and then the opportunity costs of conducting a business, or doing a business, or running a business, let's say. Implicit costs. What are these implicit costs? Well, these are basically opportunity costs. For example, your implicit cost is basically wages forgone for this hour. If you earn it here, you would have been working, right? Or having a rest at home, or playing a game, video game, let's say, yeah? So these are factored into the economist's cost calculations. So your cost here, to be here, for this hour, your cost is basically whatever you paid to commute here, plus whatever you haven't earned. £10 an hour, for example, yeah? Something like that. So that's your cost of coming here and attending. Maybe even more if you have explicit costs. But I suppose your opportunity costs are not high at this moment because you don't have a degree. But if you have a degree and you work for a restaurant as a waiter or waitress, then you will have a huge opportunity cost. Because with your degree, you could have been earning much, much higher than what you would be doing, yeah? So right now you're learning, so your opportunity costs are lower. So moving on now, so keep this in mind, the differentiate between the two. I'm moving on, I can see some of you are typing, but apologies, guys, we have to move on. We don't have much time. So let's take this case. This is a cost structure and profit structure for, or let's say this is profit statement for a store manager. Let's say you're working for a store as a manager, but then you also have an option to start your own business with some investment. If you were to start your investment, let's say you're earning, let's say £45,000 a year. This is dollars, but assume this is in pounds. Now, if you decide to go and open your own store, then you are the owner of the store. Your cost of goods sold would be 300,000. Your general and administrative expenses would be 150,000. Together, your total out-of-pocket accounting costs are 450,000. Now, since you have given up the opportunity to continue working as a store manager, instead you're now working as your own boss, you are the owner, then you've given up 45,000 as a store manager, the salary you would have earned if you were working for another company instead. So that's 45,000 foregone opportunity to earn. Now, and also foregone return from investments. Let's say you invested 50,000 into the business, and that 50,000 you savings would have been earning you 5,000 a year return at 10% if you were to put it into a bank account. So that earning has been given up as well. So together, sum of the two, basically 45,000 and 5,000 is your implicit cost or the opportunity cost here, 50,000 that you didn't earn by doing alternative, running your own business. Yeah. Now hold on to this. Now total economic costs as a result now is accounting cost plus the opportunity cost, 500,000. Now, moving on, let's look at your profit statement now. Revenue, let's say, is 500,000. This is a business as usual case. Take away the accounting costs, 450,000 from here. So take it away. And opportunity costs, 50,000 here. Take them away. Zero profit. Notice this. You are making a normal profit. That's because your revenues basically covering your accounting costs and also opportunity costs. But you are making an accounting profit here. 50,000 is your accounting profit, which is used to cover your opportunity costs. So normal profit doesn't mean no profit. It means for an economist, it's basically a profit equal to zero. But for an accountant, it's a profit, a positive profit for an accountant. For you, it's still a 50,000 profit as an owner of the business. But that 50,000 is just enough to cover your opportunity costs. And you're happy to carry on with the business. Because you're just making a normal profit, average profit, that everyone else is making probably in the market. Now, what if you are in a boom? Then your revenue is 550,000. Take away the accounting costs, so your costs didn't change. Take away the opportunity cost. You now make an economic profit, £50,000. That's also called supernormal profit. It's basically the revenue basically covers your accounting costs, your opportunity costs, and there is excess amount as well. That's 50,000 is your supernormal profit. Now look at this economic loss. This is, however, not an accounting loss. Look, 400,000 is your revenue. Take away the out-of-pocket costs, 450. You still have 30,000 out-of-pocket profit that you pocketed. But that 30,000 doesn't cover the 50,000 foregone earnings. Yeah. So from an economist's point of view, you are making economic loss. But from an accountant's point of view, you are making proper profit. You are making a profit. You're making monetary profit. Your hard profits are available there for you to spend or to reinvest. So it's just economic loss means the profit you earned doesn't compensate for the risks you've taken by investing that amount, whatever you invested, yeah? Basically, your earnings are not enough to cover your opportunity costs. Although they are enough to cover your accounting costs, they are not enough to cover your opportunity costs. So that's the idea behind this profits, economic profits and accounting profits. So next week, for next week's classes, I'll introduce or I'll add a question on economic and accounting profits. This week we will look at economic and accounting costs. Right, so if you're an economist, this is how you would see your revenue being split between economic profit, implicit costs, and explicit costs. While if you're an accountant, this is what you would see. Yeah, so economic profits basically are the amounts excess of explicit and implicit costs. So profit maximizing firm now. How would then firms maximize their profits? Now, before we move on, these total costs and average total cost and average variable costs, I want to mention this, that they incorporate the implicit and explicit costs. Yeah, so this average variable cost incorporates the implicit and explicit costs. In that case, we can apply the normal profit assumptions here, that firms are able to make normal profits. Now, let's look at the industry's supply and demand diagram here. So the industry supply and demand is basically your usual supply, downward sloping demand, and then an upward sloping demand curve. The opposite, downward sloping demand curve and then upward sloping supply curve. And this is the market equilibrium, PE. So millions is the quantity. And notice here, because the firm, an individual firm here to the right, is the price taker, is not able to determine the price. They will take the prices given and sell at that price. So this line here is their price line. So the price is equal to then, as a result, average revenue, which is also not equal to marginal revenue. So each additional unit sold will be exactly the same price, basically, because it's a horizontal curve here. They take the price given. Now, where do the firms sell? What quantity do the firms sell now, individual firm, given that there is a market demand determining, supply and demand determining the price? What quantities do the individual firms sell? Well, they sell the quantities that correspond to a point where marginal cost is equal to price, or average revenue, or a marginal revenue. So this is basically a rule where marginal cost equals marginal revenue is where the firms in perfect competition, in fact in all other market structures, firms maximize their profits. Now let's start with this point, Q1, when they start with the Q1 units. Notice that Q1 units are supplied at the marginal cost of this price, let's say, or this amount. But this marginal cost is less than the marginal revenue the firm is getting for these products. So there's an incentive to produce more, because even if they produce more, they are still making profit here. Marginal revenue is more than the marginal cost. So each additional unit they produce brings profit. So why not to produce more? As they produce more, they eventually settle at this point, where marginal cost is now equal to marginal revenue. Beyond that point, basically, marginal cost is higher than the price. So producing beyond that point doesn't make sense. So they settle at this point, and this point, as a result, is a rule for maximizing profits. At this point, profits are maximized for perfectly competitive firm. That's also the Q max. Now, let's say a firm starts at this point where a Q2 quantities are produced. But then marginal cost is above, this point is above the price point. So making this product is not profitable. Making that additional unit is not profitable. So they reduce quantities produced until they settle at this, again, the marginal revenue equals marginal cost point. That's the point where their profits maximized. Now, this may not sound nice when logical or sensible when you actually just sell at the price where quantities where that prices are equal to marginal costs. But with a bit of explanation, you should get it, hopefully. If you're doing economics for the first time, bear with me for now. We will also look at these cases in the in the seminars as well. So let's move on, and then I need to define a few bits where you will then realize why the marginal cost equals marginal quantity point is the profit maximizing point. Right now, you could actually decide it as well, but you could as well see it that this point is the profit maximizing point by comparing the price to the average total cost if you want. But I'll leave it for a later discussion now. Yeah? So let's move on. So compare the average total cost to price, and you will see why this point is important now. Why this point maximizes the profits. I'll move on now. Now, marginal cost curve is usually considered to be short-run supply curve for a firm. Why? That's because, let's see this. Let's assume that the firm right now on the left-hand side here, right now, sells the quantity Q1 at a given price P1, and this point is the profit maximizing point. I removed all other lines, and it's also the same in the slides in the book. The price line is removed basically, so that we have a better picture here. So notice this. This is the point is now where price equals marginal cost. Now imagine that something happened in the market and the firm's price in the market increases to P2. When the price increases to P2, what happens is that price is now above the marginal cost. So firm now, in order to maximize its profit, will have to move production. So the firm then moves from Q1 to Q2. So decision to produce is now makes the firm to move along the marginal cost curve. Yeah? When you move along the marginal cost curve and supply the quantity required to maximizing the profits, then you are basically moving along the supply line as well. So marginal cost curve, in a way, is also a supply for short run. Yeah? In the short run is a supply curve as well. It's also upward sloping. Now notice the case now. The second case where Q1 is determined by P1. So the price is higher here, and this is the profit maximizing quantity because price P1 equal to marginal cost. But in the market now, something happened and demand declined. As a result, price declined to P2. Price decreased to P2, let's say. At P2 now, notice that cost for this firm is above, or at this Q1 at the moment, cost for this firm is above the price. So that price is much higher, much lower than its cost of producing that marginal unit. So what happens now is that the firm now reduces the quantity gradually, where it then ends up settling at the P2 Q2 combination. This is the price profit maximizing combination as a result. Yeah. So these movements along the marginal cost curve is similar to movements along the supply cost curve or supply curve. So as a result, we consider the marginal cost as the short-run supply curve in perfect competition. Now you might ask, will the firm continue producing at any price that the market gives it? It doesn't usually. In a perfect sense, firms do not operate constantly or continuously or sell at quantities at the given market price. If the price for a long time is below the average total cost of the firm, firms usually exit the market completely. But for a short period of time, if the price is just below the average variable cost, firms may shut down in the short run. Shut down means ceasing the operations for a temporary period of time. Exit means exiting completely the market. Yeah? Shutdown rule for a firm in the short run is when price falls below average variable cost. Think of it this way. This is your marginal cost curve, and we define it as a short-run supply curve. But firm is not willing to supply the quantities that are corresponding to lower prices than the average cost. That makes sense, because if the firm is not able to cover its variable cost, because variable costs change with the production, right? Cost of production increases with the additional units, and that's where variable costs kick in. So if the variable cost is below the price, there's no point in supplying it. But firm can supply the quantities to the market if the price is above the variable cost, but could be below the average total cost. Yeah, because think of fixed costs. Fixed costs are usually fixed. You'll have to pay them whether you produce or not. if the price is just covering the average variable cost, why not to supply? Because if you don't supply, then we will end up paying fixed cost if you don't produce. So in the short run, as long as the price covers the variable cost, firm produces. And it ignores the fixed cost because it's sunk cost. It's a period cost. It's been decided long time ago, before even the production started. You pay the rent whether you produce or not. You pay the lease, you pay the fees whether you produce or not. So it becomes a sunk cost. Fixed costs become a sunk cost. So you ignore the fixed cost in the short run, and you produce and sell the quantities which are sold at prices above the variable cost. So you don't shut down in the short run if your price is above the variable cost, but if the price falls below the average variable cost, you should shut down because it now doesn't even justify the variable costs of producing the next unit. Right? So that's the short run shutdown decision. And the long run shutdown decision is when, if you keep producing below average total cost for a long time, but even if it's above variable cost, it's a long time, it's in the long run, it's a loss, isn't it? It's quite a loss. It accumulates. So you'd rather leave in the long run if the firm doesn't get prices above the average total cost. Yeah, firms don't usually keep producing for let's say for a constant 2-3 years if the prices are below the variable costs and even below the average total costs and remain below average total for a long time. Yeah, remember this average total cost. Basic average variable cost is below average total cost, but in the short run we are able to produce at the prices and sell at the prices below the average total cost, but we cannot really continue selling at below average total cost in the long run though. So in the long run, decision will have to be made based on whether price is below or above the average total cost. So that's the rule for exit now, not shut down, exit completely, leave the market, produce something else. Right, so this is the rule. If the price is below average total cost, in the long run, firms exit completely. Now, here it is. It's the point where I've been trying to mention here earlier. Let's look at the short run profit maximization case here for a firm. So this is the typical average total cost for a firm, and marginal cost is vertical. It is actually usually J-shaped, but it's vertical. It's a straight line right now. Ignore it. So we're looking at the straight line point anyway in this case. So price is given here in the market. This is the price, and the firm has an average total cost of this curve along this curve. Now, the quantities that the firm supplies are determined by the rule. Yeah, remember the rule is the firm sells the quantity where marginal cost equals marginal revenue. So they're selling this Q quantity, and that quantity, the price is P, given P here. So the difference between now the price and then the average total cost corresponding to this quantity is basically the profit per unit. And if you times the profit per unit by the quantity, that gives us the shaded area, which is the profit. So this is called profit or economic profit. In some books, supernormal profits or above average profits. So if you're using different books, then these are similar or identical basically concepts. Basically they're defining the same concept. Yeah. So this area here is a profit for a firm. But now, if there is a supernormal profit in the short run, in the long run, new firms enter the market. So they enter the market to take advantage of the profits. And once the firms enter the market, what happens is that the market price goes down. Now look at this case. Now market price is now this price line here showing us the market price where the price is equal to average revenue and also it's equal to marginal revenue. Yeah. So it's now for this typical firm is lower than the average total cost per unit. So basically this firm costs are higher than the prices that market is commanding now. So the difference now is going to be loss per unit here. And firm is only selling Q units at this point because that's also the point where they can maximize the profit or minimize the loss. And we'll look at why it is the minimizing point or maximizing point in more details in the seminars. So the difference now is a loss, economic loss. So the firms usually don't remain in the market in the long run if this is the case. But in the short run, they may stay as long as the variable cost is above the price. But in the long run, this is an exit situation. Economic losses command exits. Now, I am going to skip this point. This is self-explanatory, and it just tells you why the supply line is horizontal, and it's not essential.